there's a few things that you need. You need to have a long-term outlook. You need to have the liquidity to not need that cash within that time period. You're also going to need to have the liquidity to pay the capital gains that you originally deferred. In my mind, it's more of the mentality of being able to be in this long term, as well as liquidity to not need that capital in the short term. If you think you're going to need it within the next 10 years, probably not the best investment for you, because you might get some money out through a cash out refinance, but you have to lock up this money. If you take the money out before 10 years, you're going to lose the benefit. So you need to have a long-term outlook.
Today, we're going to talk about qualified opportunity funds, which is how you invest in qualified opportunity zones. So we've talked a lot about this lately because this is one of the best tax advantage ways that I have seen to potentially have some 1031 benefits or similar benefits, but eventually break that 1031 swap until you drop cycle. So today's podcast, I am joined by the Property Development crew. I got Caitlin, Christy, Paul, and Jamin in here. They are participating and also investors themselves, and they're learning about QOFs. I know a few of us here at the table are actively selling properties to invest in these deals. So we're here to learn about this. And we have a special guest, Thomas from HallCPA. Now, HallCPA has been a friend of ours for a little over a year now, but we have done a few webinars with them over the years. They're CPAs that specialize in real estate investing. So they're a great educational resource. And also, if you ever need a CPA, I would definitely recommend checking them out. But Thomas, I know I emailed you 2 weeks ago and you said, hey, do you have any QOZ stuff? You said, I do, but I got to update it. And you were very gracious enough to update the slide deck for us. So thank you.
Yeah, no problem. You know, this is the subtitle here, the most overlooked tax strategy. And the reason why I put that there is because this came out in 2017 and it's honestly, I think, not talked about enough. So happy to do this presentation here today.
Wonderful work side. So please jump into it.
All right, cool. So what we're going to be covering today for everybody here who's tuning in, what are qualified opportunity funds? We're definitely going to be touching on that. Then the tax benefits of actually investing in one of these funds. And then if you're going to run one or considering it, some of the requirements around it, specifically around real estate, because that's why we're all here today. And then we'll be taking some questions throughout, and that's going to be exciting. So let's just go ahead and dive in. Quick disclaimer here. What we're going to be going through today is for informational purposes only. Obviously, when you're dealing with something like Qualified Opportunity Fund, you do want to speak to your own tax advisors, make sure that you're doing everything correctly and that it makes sense for your situation. There's like with many strategies, a lot of nuances that we may or may not cover today. So definitely want to make sure you're doing that right. All right. So what are Qualified Opportunity Funds? So let's take it back to 2017, the Tax Cuts and Jobs Act. They introduced something, what's called Qualified Opportunity Zones, which are effectively census tracts in low income and distressed areas that they designated for revitalization. There's around 8,800 of those or so throughout the country. If you go online, you can find where those individual census tracts are. But that's a Qualified Opportunity Zone. Now, the Qualified Opportunity Fund is the vehicle that investors use to invest into the opportunity zones and regentrify or revitalize some of these areas. And taxpayers who meet certain requirements, which we'll be going through today, are able to get certain tax benefits by investing through these qualified opportunity funds. So let's go ahead and dive into that. So what are these major tax benefits? Well, the first benefit you get as an investor is you get to defer capital gains tax. It could be long-term capital gains or short-term capital gains by investing the capital gains into the Qualified Opportunity Zone fund within 180 days from that event happening. So quick example, if you were to sell a stock today, whatever that capital gain is, you have 180 days from today to go ahead and reinvest that into the Qualified Opportunity Zone fund. As we'll talk about a little later on today, unlike 1031 exchanges, you do not need to invest the entire sales proceeds. You just need to invest the capital gain. And it's not limited to just real estate gains. It's any capital gain from any capital asset. So stocks, bonds, financial equities, things of that nature, those are all on the table here. So when you defer these taxes, you're deferring the taxes until April 15, 2027. So the original capital gain. So say, for example, you sold Apple stock today, not picking on Apple, just using them as an example, and you had a $100,000 capital gain. Well, you're not going to have, normally if you sold that in 2025, you're going to pay taxes on that in 2025. However, with the qualified opportunity fund, you're deferring those taxes on that $100,000 capital gain until April 15th, 2027. That's when that tax is going to be due. Now, there used to be a provision that you can't use anymore, unfortunately, that if you held it for 5 years in the fund, that you would get a step up in you would basically reduce your capital gain that you're deferring by 10%. If you held it for 7 years, by 15%, but you have to hold for 5 and 7 years respectively. Unfortunately, those phased out in 2019 and 2021 when you were no longer able to hold it for 5 to 7 years before 2027. So if you're wondering what about that, that's no longer in play, which is why I'm not going to put too much of an emphasis on that here today, but did want to mention it. Now, the last day you can invest in a qualified opportunity fund under current law is December 31st, 2026. So that's going to be the last day you can actually inject the money into one of these funds. Now, you can invest non-capital gains or just plain old cash, for lack of a better word, into a qualified opportunity fund, zone fund. But it's important to note that only the capital gains themselves will receive the tax benefits. So, for example, if I invest $100,000 of capital gains and $100,000 of cash, that's all well and good, but the capital gains are gonna get the tax benefits. And you'll see right here what I mean by that. So probably the biggest tax advantage of investing in the qualified opportunity zone fund is not actually the deferral of taxes. It's the 10-year benefit. So if you invest in a qualified opportunity zone fund, you hold for 10 or more years, you'll pay no capital gains tax on the appreciation of that qualified opportunity zone fund investment. Say, for example, you invest that $100,000 of capital gains in the qualified opportunity zone fund. In 10 years, it appreciates to $1 million. You 10x your money. Well, that $900,000 capital gain is exempt from taxes. So you will not pay taxes on the gain from the qualified opportunity zone fund itself. It's important to note that you still have to pay taxes on April 15th or by April 15th, 2027 on the original gain you deferred. Right. So if we're continuing with the $100,000 example from Apple, you're going to have to pay taxes on that no matter what. You can't avoid that. But when you sell the qualified opportunity zone fund or it liquidates, the actual appreciation on that's going to be tax exempt if you hold for at least 10 years.
So this is a great overview. And so I want to, because I'm looking at a deal right now and I want to make sure I understand the tax benefits. So say this is a 10-year development deal. They're going to build an apartment building, and in year 3 or 4, they'll start doing cash flow distributions.
Right.
So the cash flow I receive in years 4 to 10, I pay normal income taxes on. There's my understanding. But when the property is sold in 10 or 11 years, I don't pay taxes on the capital appreciation portion of it.
Right. Exactly.
Great. Thank you.
Exactly. I think we just went through this example here, but here's another example here on the screen of how it would work. But we'll go ahead and skip that because we just talked through it. So the 180-day rule for deferring your investments sounds very similar to the 1031 exchange because 1031 exchange, you also have 180 days to reinvest. Now, again, you only need to reinvest the gain, not the principal. If you do invest the principal, it will be considered cash, and you wouldn't get that 10-year. Like if you invest cash, what happens is in 10 years, you're not getting that exemption, right? It's only that 10-year exemption of capital gains is only on capital gains that you defer, not cash. Now, the 180-day period does begin on the day which the gain would have been recognized. So again, if you sold stock today, for example, it would be 180 days from today. Now, there's some interesting things that happen with partnerships. And I know a lot of people who invest in real estate are often doing it through partnerships. So the partnership 180-day clock begins on the date the partnership would have recognized the capital gain, which would also be usually the day you sell the capital asset. However, partnerships can pass through their gain, that clock can pass it through to the partners itself, and that clock will not begin to the last day of the partnership's taxable year. And if the partnership ends up doing that, the partner can actually go ahead and begin its own 180-day period on the same day that the partnership would have recognized it. So notice some nuances there. The long story short of it is if you're in a partnership, the partnership can make a decision, say, okay, great, we're going to start the 180-day clock here today. Or they could say, we're going to pass it down to the partners. In that case, the partners have the option to make that 180-day clock start at the end of the taxable year, or when it was originally going to be done by the partnership anyway. So it just figured that would be of help for some people who are investing through partnerships.
Well, so it sounds like if you have a partnership, you have the potential to extend the 180-day deadline if that's a better fit for you, is how I'm understanding it.
Right, exactly. And, I don't know exactly why they did that, but just knowing how partnership taxes work, oftentimes distributions for partnerships for partners aren't done, right then and there. They might not be done till the end of the year.
Yeah.
So that gives them flexibility to say, okay, now I know as a partner, I know what my numbers are going to be. And now I can start my 180-day window, at the end of the year, rather than having to start it when we sold the stock, when someone sells the stock in the middle of March, for example. So
that makes a lot of sense.
So that's more on the 180-day. Qualified opportunity zone funds are an exit strategy for capital assets because you are deferring those capital gains, and it's often compared to the 1031 exchange. So we give a quick rundown of some of these differences. So with the tax deferral, the qualified opportunity zone fund, you're deferring the taxes until April 2020 to April 2027 when you would have to pay those taxes. With 1031 exchange, you could potentially defer your taxes indefinitely, potentially forever if you do end up passing your assets down to your heirs. So there's a little bit of a difference there. The tax-free gains, that is on qualified opportunity funds if you hold for longer than 10 years, as we discussed before. But with 1031 exchanges, that does not occur unless you hold forever and you pass it on to your heirs. In that case, the gains are eliminated with that step up in basis that you get when your heirs inherit your properties or your other assets. Depreciation recapture, with a qualified opportunity zone fund, it is eliminated just like capital gains, eliminated after 10 years on that investment. With the 1031 exchange, it's usually just deferred right along with the capital gain. With the investments, qualified opportunity zone funds, really any capital asset can qualify that generates a capital gain. But with 1031 exchanges, it is only real estate. And within that, with qualified opportunity zone funds, you can invest in real estate through the qualified opportunity zone fund, or you can invest in businesses. The business aspect of it's a little bit more complicated, but a lot of people do take advantage of the real estate element. The timeline, very similar timelines, 180 days to reinvest with the QOF. With the 1031 exchange, you do have that 45-day identification window, then 180 days to close. So the key takeaway here, qualified opportunity zone funds, after 10 years, you get to wipe out that capital gain on the appreciation, whereas 1031 exchanges, you basically have to wait until you pass away to do that, if you wanted to do that. Otherwise, if you sell the 1031 exchange and not do another one, you will incur all those capital gains taxes.
So this is a great comparison table, Thomas. So I got two questions. So for the QOF investment, I have 180 days, but you do not have to use a QI like you do for a 1031, right?
Nope.
Okay, so no QI. The second is, so I did not know this. So depreciation recapture on the QOF investment, that is tax-free as well?
Yep.
Wow.
Yeah. And that's because if any tax people are there listening, like the way the QF investment works, when you defer your capital gains, your basis in that investment, in that partnership or that corporation is zero. And what happens is at the end of the 10 years, the basis is stepped up to the fair market value. So it's wiping out the capital gains and recapture at the same time.
Dude, that's an amazing benefit. So even if they go out there and do a cost segregation study in year 4, 5, or 6 and pull for the depreciation, it ultimately doesn't matter.
Right, because it's all going to be wiped out at the end. One more thing I forgot to mention here that's important to note is, and you mentioned that with the QI, which reminded me of this. With the qualified opportunity zone fund, you don't actually need to use the exact proceeds from the sale of the capital asset. Like, what I mean by that is, I'm just going to keep using this Apple example. You sold your Apple stock today, and now you have $100,000 of capital gains sitting in your bank account. You could take that $100,000, go and spend it, take another $100,000 you have sitting in your bank account and invest that. So it's with the 1031 exchange, the sales proceeds sit with the QI and then are given over to the to the seller of the asset you ultimately acquire. Here, it could be any cash. The cash doesn't matter where it comes from, as long as you have a capital gain that you have and you can that you can defer. If that makes sense. There's a little tidbit there. Okay, so now actually running a qualified opportunity zone fund, this is where things get interesting. So qualified opportunity fund must be a partnership or corporation. It cannot be a single member LLC. It cannot be a sole proprietorship. It has to be a partnership or corporation. If you have an existing partnership or a corporation, it can elect to become a qualified opportunity zone fund. However, the assets, only the assets that are acquired after 2017 can actually qualify for the opportunity zone fund treatment, meaning you can't, if you have a portfolio right now that's sitting in an opportunity zone fund, you acquired it back in 2015 or 2000, whenever, if you elect that qualified opportunity zone fund treatment on that entity, those will not qualify as qualified opportunity zone fund property. So it's important to note there. The election, you can treat, when you make that election, you decide which month you want that election to start. And that gets important as we kind of look at some of these requirements. So 90% of the qualified opportunity zones property must be in a qualified opportunity zone, okay, or an eligible partnership interest or stock, and that's tested on a semi-annual basis. So basically, when you can't just have money sitting in cash, you can't have it sitting in the stock market, just sitting there. They want this money to be used to revitalize these areas. So to go a little bit deeper on that, the fund must hold 90% of its assets, again, in qualified opportunity zone property, which is one of the following. It's newly issued stock of a corporation that's presumably going to be acquiring real estate or a qualified opportunity zone fund business, or newly issued partnership interest, or tangible business property in a QOZ, including real estate. So in other words, for most real estate investors, what you're going to do, you're going to have a qualified opportunity zone fund. You're going to go buy the asset in that fund. Is usually what happens. Now, running a qualified opportunity zone fund, we're going to continue this. In order to qualify on the real estate side as qualified opportunity zone fund property, it must be one of three things. Okay, it must be vacant for over 3 years and before you acquire it, and vacant means less than 20% occupied over the 3-year period. And this basically, again, the purpose of this is they want to take underutilized buildings and underutilized spaces and basically allow you to acquire those and start getting them in working order to revitalize the area. The second way you can do this is the substantial improvement requirement, which is pretty much like a value add project for anybody who's familiar with those. You're going to go ahead and purchase an existing building, and you must actually invest. You have to double the building's basis within a 30-month period. So, for example, if you bought a property and the building cost $4 million and the land value was $1 million, so in other words, the purchase price was $5 million. We're looking at the building cost here, and you have to spend at least $4 million on improvements on that building. So we're talking about substantial renovations, and we often see this, in multifamily renovations or commercial building conversions within opportunity zone funds. And again, this isn't a light value add. This is a substantial overhaul here that we're talking about. The third one is ground up development. So you can purchase vacant land or demolish an existing structure and build new. Here, with ground up development, there is no substantial improvement requirement because you're building it from scratch. So you could see it's an apartment complex, mixed use developments, or commercial properties. But again, you can't just buy a piece of property in a qualified opportunity zone fund and do nothing with it and have it qualify. You need to be meeting one of these three requirements in order for it to count as qualified opportunity zone fund property and to maintain your status of qualified opportunity zone fund.
Yeah, this is great. I don't have any questions on our side.
Okay.
This is great, Thomas.
No, thank you. All right. So frequently asked questions that we get around qualified opportunity zone funds. What's the last day you could invest? It's going to be the end of next year, which is 12/31/2026. After that point, you're not going to be able to defer or invest in qualified opportunity zone funds under current law. then can you invest depreciation recapture into the qualified opportunity zone fund? As I mentioned before, the actual depreciation recapture from the qualified opportunity zone fund, if you hold it for more than 10 years, will be eliminated. However, when it comes to actually investing, say you sell a piece of real estate, the capital gain from appreciation you can defer into the fund and invest, and so will the straight line depreciation from the 27 and a half year or 39-year property, depending on its residential, commercial, that can be eligible for the deferral. However, if you're basically, long story short, depreciation recapture from accelerated depreciation like bonus depreciation is uneligible to be deferred into the fund on that front end. Can you invest non-capital gains into QOF?
Sorry, I got a couple questions on the depreciation recapture, Thomas.
Yep.
I think a few of us may. So, in that example of investing the straight line depreciation, so I have a fourplex I'm looking to sell, and I've got a very low basis from a 1031 exchange, and I did do a cost segregation study. So, in my depreciation recapture, can I separate out the recapture that came from the cost seg, and then segregate out the straight line and then invest a straight line into the QOF?
Yes.
Okay.
Yeah.
And then on that note, so if I do that, so let's just say for simplistic numbers, I have $100,000 in straight line depreciation recapture.
Yep.
When it comes due for me paying taxes on the property I sold, does that $100,000 of straight line recapture, does that get taxed at the recapture income tax bracket rates, or does that get lumped into the capital gains deferral paid in April 27?
Yeah, so that's all going to get lumped into the April 27th date, but it is going to be at the rate. So the way the way this works is it retains the character of the original deferred gain. So, for example, when it comes to the straight line depreciation, that's taxed at a rate up to 25%, whereas long-term capital gains 15 to 20%. And then short-term capital gains can be as high as your whatever tax bracket you're in that particular year, up to 37%. So that's how the deferral works.
So is all depreciation recapture, whether it's straight line or cost segregation, is that all due in April 27?
Okay, I got what you're saying. No. So the straight line depreciation, the non-straight line depreciation, the other depreciation, that's going to be because you're unable to defer it. That's going to be taxed in the year that you sell.
Okay, so if I sell this fourplex this year, and let's say I have $300,000 in appreciation recapture, $200,000 from a cost seg study, $100 from straight line. If I'm understanding correctly, that $100,000 straight line will get deferred to April 27, and then my $200,000 appreciation recapture is due this tax year in 25, meaning like April 26.
Yeah.
Okay.
Yeah, unfortunately, just because those are just not able to be deferred, and we've got this question a lot over the years, and they make it relatively clear that the straight line's good because it's in tax jargon. Long story short, the straight line's good. The other two are not because they're taxed as ordinary income.
Yeah, no, that's actually that's happy to me because I modeled everything that I could not. All my depreciation was due this year. My depreciation recapture tax were due this year, and none could be rolled over into the QOZ. So the fact that I can take out the 27.5, that adds a few more dollars my way. So thank you.
Yeah, no problem. Thank Congress. Don't thank me.
But yeah, well, you're clarifying a lot of mud here, buddy. Permission granted to go on the next question, Thomas.
Okay. So again, cash. If I didn't cover this one, cash. You can invest cash, non-capital gains, but you won't get any of the tax benefits. Can you do cash out refinance? Another big question that we've not really discussed here today yet, which is after 24 months, there's a provision. After 24 months, you can refinance and return some capital to investors if you're running a qualified opportunity zone fund. And this provides some liquidity, especially if you do have to pay those capital gains in April 2027. Remember, you have to continue holding the investment for the 10 years to get that big benefit. But those capital gains are still due from the original deferral in 2027. So just something to keep in mind. And then when must qualified opportunity zone fund assets? And this is an interesting one here. qualified opportunity zone fund assets must be acquired under current law by 2028 because qualified opportunity zones expire in 2028 and they will no longer exist. However, the 10-year hold is you have until 2047 to basically hold the property and recognize that 10 plus year tax benefit there. And one thing I will say here is we spoke to somebody a few years ago who really made an eye-opening case on what the potential power of this could have been if the opportunity zones didn't expire. What you could have done is invested a lot of money, deferred a lot of capital gains into a fund, and then kept 1031 exchanging properties in qualified opportunity zone funds and have this massive capital gain just be wiped out in 2047 or before then. But unfortunately, it does not look like that's going to be possible because the qualified opportunity zones just expire in 2028. They're gone.
That's like expert mode there.
Yeah.
This was great, Thomas. Thank you. I know we've all done a lot of research here on QOZs and QOFs, and this has been the most clear and concise presentation I've seen. So thank you. I got a couple questions, and now I'm sure my panelists do as well. My first one, and this is probably a product one right now, is what's your crystal ball say about what Congress and the new administration is doing? I know QOZs are in the new, tax legislation that they're in the progress of getting through, but I'm sure you have a lot more like your finger on the pulse.
Yeah. So actually, I've not been hearing too much around QOZs this exact cycle here. There was a bill in 2023 called the QOZ Extension Act, which unfortunately was not passed, but it could. I'm going to mention it here because it could be what we see, in 2025. And what that aimed to do was extend the deferral period until 2028. So that would give people more time to invest in the funds. And then also add some reporting requirements for some more formal reporting requirements for QOZs. But as far as I'm aware, it did not do anything really material beyond extending the deferral to 2028.
Okay.
But I know what we want to see, what a lot of people want to see, is the QOZ program just get extended. Not only the deferral, but actually the qualified opportunity zones themselves get extended. Whether or not we'll see that, we'll have to wait and see. I know there's a lot that they're trying to get into this bill, and we're gonna have to see how it all shakes out.
So let me ask you. So I mean, my approach right now is I'm selling this fourplex with the intent that, hey, everything I know about QOZs, I'm happy with the numbers. I'll pay my depreciation recapture this year. I'll defer my capital gains for a year or two, and I get a 10-year benefit. And so I'm happy with those numbers. And then kind of my attitude is if Congress and administration passes updated QOZ and extends my payment period by a couple of years, that's just a nice cherry on top. Is that
Right.
kind of the outlook you're seeing investors take right now?
Yeah. For the most part, at this point, the deferral is not really like the huge benefit here.
Yeah.
The benefit is the 10-year hold. That's where the major tax benefits of this strategy are. I mean, the deferral was a little bit more impactful before 2019 and 2021 because you were getting a 10% up to a 15% step up. So going back to our example, if you were to have held for 7 years on that $100,000 gain, you would have deferred and you would only have to pay tax on 85,000. But that has since, you can't do that anymore. So that benefit's unfortunately gone. I don't know if that's going to come back or they're going to bring that back in any way, shape, or form at this point.
Great. Thank you. All right. You guys have any questions?
Yeah, I have a question more on the actual process for once you have the ground up construction going in a QOF. And specifically, my question is on how that 30-month timeline works for when it has to be completed. Because I know there's some variation of when the clock starts for the 30 months.
Yeah, so the clocks, that's a great question. So with the ground up construction, I don't know if there's actually a timeline on the ground up construction itself. I know that there is with the substantial improvement requirement, because Are you asking are you asking because like there's 90% has to be in qualified opportunity zone property? How does that timeline work?
No, more really just looking at like if I'm an investor and I'm going to invest in a QOF, I want to know that it's progressing how it needs to ensure that I'm going to actually get the QOF benefits. I think because I've heard a lot of horror stories where something has gone wrong and then they've lost their QOF status because they didn't adhere to all the deadlines. So for that 30-month clock, like is that something I should be concerned with as an investor? And then if I'm tracking that from an investor standpoint, like when does that start and when would it finish that I would expect the, finished product, I guess, to be complete?
Yeah, that's a great question. So I'm not sure that there is a 30-month window for the ground up. I know I'm taking a look now to verify, but I'm not sure that there is. But I know that if you're going to start, say, for example, with the substantial improvement, right? You buy a property, you're going to substantially improve it. Basically, what's going to happen is you have to have a plan to do it. You have 30 months with the working capital that you could say, okay, I have, we raise this money. This is our 30-month plan to get this going. And then you can actually extend it another 30 months if you need to. So you do have a window there for that working capital before it starts to kick in and become non-qualified opportunity zone property within your fund. So I don't know if that clarifies that at all.
Yeah, it does. Yeah. And then, yeah, if you find out or know from the ground up construction standpoint, if that ends up being part of it, I would love to know because 10 years is a long time. I want to watch it, make sure it stays qualified the whole time. So.
Yeah, no, absolutely. I could totally understand that because you could be expecting some benefits, right? You're investing, you don't know, and you don't have control, right? In all these situations, and all of a sudden the sponsors blow it, for lack of a better word to say, and now you're SOL. So I totally get that. But yeah, I'm trying to find right now, is there a 30-month window on the ground up? So if I can verify that while we're on this call, that would be great.
I have a question. Thomas, I'll pose this question to you, and then I will pose it to the team as well. In your opinion, who is the best candidate for a qualified opportunity zone and who isn't?
Like to invest in one or to start one?
To invest in one.
Yeah. So I would say anybody who has a long time horizon, because these are a little bit different than a lot of the investments I think people are used to. And perhaps part of the reason why these haven't picked up as much traction as they could. You have a lot of people who are used to that 5 to 7 year turnaround time on the syndication and like to flip their money pretty quick or like to have the control to be able to sell property or stock whenever they want. So you have to have there's a few things that you need. You need to have a long-term outlook, right? So you need to be able to put this capital to work for at least 10 years, maybe longer in some cases. So you need to have the liquidity to not need that cash within that time period. You're also going to need to have the liquidity to pay the capital gains that you originally deferred when you sell. Like that $100,000 I'm talking about, that's going to come due in 2027. You need to have the liquidity to pay that, despite the fact that you're deferring that into a fund, which you're going to be locking it up for at least 10 years. So, I mean, in my mind, it's more of the financial, the mentality of being able to be in this long term, as well as liquidity to not need that capital in the short term. If you think you're going to need it within the next 10 years, probably not the best investment for you because you might get some money out through a cash out refinance, but you have to lock up this money. If you take the money out before 10 years, you're going to lose the benefit. So you need to have a long-term outlook.
Thank you. And team, what do you guys think as well? Is there anything else you would add to that?
No, I think I agree.
Well, obviously you have to have, it's most beneficial for capital gains, right? If you just have regular old cash, then you're not going to benefit from it.
Yeah. To elaborate a little bit more on your question, because I'm thinking about it a little bit more. If you have assets with substantial capital gains, right? This could be an opportunity to sell those and invest them. And while you can't really defer, while you still have to pay taxes on those capital gains, your actual investment return from a tax perspective could be substantial. Because let's say you're a family, right? You have an asset, you sell $10 million asset that maybe $5 million of that's the gain. Well, I mean, if you invest that, the return on that, if say that $5 million in a qualified opportunity zone fund appreciates to, let's call it $20 million, right? Now you have a $15 million gain that you're not going to pay taxes on. And you just need to have the liquidity to pay taxes on the $5 million gain in 2027 when the deferral comes due. But the gain you stand on the 10-year part is substantial. So if you have some assets that have if you have a substantial amount of capital gains that you can unlock or sell to use for this, that would be ideal for this.
Great.
Or help you maximize returns.
Any other questions?
I have another. It's a very complicated question, so maybe we might not be able to get the full answer. But so, from going back to the hey, I'm an investor in a fund perspective. Yeah. So again, we're going 10-year timeline. What would you say are the key tax checkpoints that I would want to hear from my operator year over year? That hey, yep, we did this. Yep, we did this. I know you mentioned earlier, the twice a year you've got to check and validate that 90% of your assets. And it's not just that they are; it's that you have to file a form saying that they are. What would be the key things that I would want to hear my operator was doing from a tax perspective each year to ensure that it was staying on track for the QOF benefit? Yeah.
If I'm an investor in this, I definitely want to make sure that 90% test is being done. I would want verification from a CPA saying yes, this is. We started in January 1st, for example, just to keep things simple. We passed the first test. I'd want to hear in July that test was passed, right? I also want to hear in the January the following year that test was passed. And I also want to hear if there's any risks to that test not being passed and why. I'd also want to know about the working capital safe harbor because, for example, 90% of your assets within the Qualified Opportunity Zone Fund have to be Qualified Opportunity Zone property. But if you have a bunch of cash in there, that cash you have a safe harbor of 31 months, basically say, okay, we're earmarking this cash to be used to build the property, to substantially improve it, whatever the case is, whatever route you're going there. So I'd want to know what that plan is, and that plan is in force. And I also would want to know when that 30-month period is coming due, are they planning to use their extension on that for another 31 months? That's what I want to know. And I would even go as far as to say, I'm thinking I'd want a balance sheet. I want to see what the balance sheet is. What are you holding in the Qualified Opportunity Zone Fund, just so that I know as an investor that there's no risks that may not be communicated to me or may not be, I want to be able to perhaps foresee that myself. So for example, if there's, trying to think of a good example. If there's a substantial amount of cash in there that's not within that 30-month window, I would want to know that. If there's property that's in there that there's no plan to either substantially improve it or do ground up development, I'd want to know that. So I just want to make sure all those requirements are being met. And I want to know that probably every 6 months because of that 90-day test or that 90% test every semi-annually.
Okay. Yeah. Okay. All right. And so then one follow-up question on that. So you mentioned that 90% of that property piece of it too. So again, that's only if they were for some reason oh yeah, we raised capital to do this investment, and while we were waiting to get all of our permits and stuff gone through, we decided to pick up this other piece of property over here to sort of pass the time. Okay, that makes sense.
Exactly.
All right, and then with the 90-day test, this was just a question I had on how it works. So I think you answered it, but I can pick when I want to do it, and then the next 6 months, because it has to be twice a year that it gets done, right? There's no hard and fast, it's due by July 1st or something like that.
Well, it would be when you start the fund. So say for example, you can open an entity, right? I can open an LLC today, tax as a partnership, for example, buy a property. Then I can elect when the QOZ fund is going to start.
Okay.
So say you buy the property in March, but you want to give yourself some wiggle room. So you elect the Qualified Opportunity Zone Fund to start in June. And now you're looking at being tested in in December, for example, and then again next June, right? That's kind of what that element, that's how that works.
Okay, and then last question, and then I'll turn it over. So from again, like a investor in a fund standpoint, so Chris, Paul, and I are all going to invest in this fund. Chris puts his money in, but I don't get mine in for another 3 months.
Yeah.
Chris's 10 years doesn't start until my clock starts.
No, so it's gonna your investment's gonna start. Your 10-year clock's gonna start when you make the investment.
Okay, even if someone else in the same fund puts their money in later.
Right.
Okay.
So on the sale of the QOZ asset, for the whole investor pool to get the benefit, is you essentially have to sell 10 years from the last day of the last investor.
Pretty much, if everybody's going to take advantage of that. Yep.
Great. So I got a question. Oh, go ahead, Paul. So a question: if you are selling a 1031 property that has been rolled several times, and your capital gains with depreciation added back in are more than the actual proceeds that you would receive at the time of sale, how does this work when rolling over your proceeds, which doesn't meet the actual capital gains? For instance, a $1 million capital gains, but receive only $700,000 in proceeds. What happens to that $300,000 difference?
That's an interesting question. I don't know that I've ever seen that scenario happen before. So basically, you had $1 million in capital gains, but you only received 700,000. I guess that can happen. I guess if you keep rolling it over for a long period of time. That's a good question. I honestly don't know if I know the exact answer for that. To be honest with you, I mean, I would imagine you could just roll the depreciation that with the straight line and that capital gain over, but you need to come up with the cash somewhere else. That's my initial stab at it. But to be honest with you, I don't know 100% offhand.
And that brings up another question that I have too, going back to the 1031 versus a QOZ. We often have investors who have either done a 1031 or who want to do a 1031. And there are trade-offs to both. And so you just talked about the lack of liquidity with a QOZ, and that investors, should they want to do a QOZ, be prepared for that. Would you agree with, I've heard this argument before, that a 1031 would be better for liquidity? Do you agree with that or not? And you can poke a hole in that argument.
But 1031 exchange would be better for liquidity. I would say that it is, because you have more control over when you can refinance it if you wanted to, and if you have that option to go make that decision, or you can sell it if you needed to, and tap into that cash within the QOF. You know, there's a lot of things at play. You don't have control over, unless you're the one running it. You don't have control over when that refinance is going to occur or not. You don't have control over when they're going to make the distributions for that. You don't have control over when they're going to sell the property. So I would say that 1031 exchange does give you more flexibility from a liquidity perspective, especially if you're going to be the one who's going to be able to make those decisions.
Great. I know we got a few minutes left. Any other questions? Because I have one question we'll end with. Anything we're forgetting to ask Thomas? Probably not, I would imagine.
I mean, there's a lot that I guess could be asked here. But you know, at the end of the day, I think we covered a bunch. I'd have to have specific questions at this point. This is overlooked. Like I have not done a presentation on qualified opportunity zone funds in like a few years, because like, frankly, just no one talks about it. No, it's overlooked.
Well, what happened, what kind of stirred up our interest is, we're all Colorado-based investors or own properties in high appreciating areas, and we're done the 1031 trade-ups, haven't been excited about doing 1031 exchange anymore with the market conditions. And then one of our sponsors bought a couple really great deals in Colorado Springs, just because they're great deals. Didn't realize they were in qualified opportunity zones. And as we were talking more numbers, like, oh, this actually qualifies for QF. Like, oh, a great deal, not subsidized by it being in a QOF. And all of a sudden it perked up all of our interest, saying, wow, we all love the Springs coming here from Denver. Like, wow, it really perked up our interest. So that is kind of the backstory as to what kind of drove this. But we appreciate you updating the presentation. And my last question, this is for Christy and Paul and myself. I know we all had looked at QOZs before and were fairly interested. After this presentation with Thomas, are you more interested, the same, or less interested, Christy?
I would say I'm a little more interested. I was pretty interested before. I'm a little more interested because you confirmed my belief in depreciation, which makes me very happy because I was not an educated landlord when I purchased the property that I'm looking at selling, and I did not do a cost segregation study, and so I only have straight line depreciation, and so I get to take full advantage of that with this.
Paul.
Well, I would say I'm much more interested. I feel like this is probably one of the more successful, if not the most successful tax, government-sponsored tax opportunities I've ever seen, with the hundreds of billions of dollars that have been invested into these zones, and not a lot of people understand them. And I understand them a lot more today than I did just a couple of weeks ago. So, I think it's an excellent opportunity, and I'm looking forward to ending the swap to drop idea. So we've been doing it for a long. We've been doing 1031s for a long time, for about 15 years, and this is a great exit opportunity.
Great. And I'm along with you guys. I'm more interested now. I already was like, the train had already left the station, but after getting that depreciation clarification, I'm like, oh, I can shift a few more dollars into QOZ. So that's a nice cherry on top. So Thomas, thank you so much. We appreciate it. And for any of our listeners out there, we're happy to give you the resource we know about QOZs, the resource on deals we're looking at. But if you guys need accounting advice, which you absolutely do, whether it's your CPA or if your CPA is not familiar with taxes, I can give you a big endorsement to go connect with HallCPA. They've been a great educational resource for us, and quite a few of our clients over the years have used them. And I've only heard great things about our clients working with you guys. So we appreciate you, Thomas.
And thanks for having me. It's always a pleasure.
Cool. All right, everyone. Well, we'll let you get on the rest of your day. Let us know what questions you have. Bye, everyone.